Welcome back to my channel. In this video, I'm going to take a turn in a different direction. In a live stream I hosted a few days ago, a viewer asked if I could create a valuation video for a person that doesn't have a finance or accounting background. And in this video, I'm going to be valuing a company from scratch and trying to explain how I value companies and use some of the principles that many value investors have used for many years. The techniques have been proven for decades. If you look at the way Warren Buffett values companies, he uses discounted free cash flows. Charlie Munger, this was his technique. And you can go from an investor to investor and find that discounted free cash flows is the technique that's used most often. You'll also find that the most valuable companies on the stock market, like Microsoft and Apple, generate high levels of free cash flow. So it's my intent to find companies that generate a lot of free cash flow and then value those companies, hopefully find them when the market is ignoring them, isn't aware of them, doesn't like them, and I buy it at the right time, and I see my investment go up over time. I'll be going slow through my video, just really making sure that I go through every step so that anybody watching this video could create a discounted free cash flow evaluation. The spreadsheet I'm going to use, I created, and you could recreate it. I'll share the formulas on the video so you can recreate it. I'll go through and explain each topic and make sure that I'm covering each topic in a good way. But keep in mind, you can always look at the topic and do your own analysis just by doing a Google search or maybe even searching on YouTube to get videos to give you even more information on a particular metric or topic or concept that I'm explaining. The company that I'm going to use in my video is Ternium. This is a steel producer of rolled steel. I found this company a few years ago, and there's a purpose in using a company that probably most people never heard of in an industry that probably isn't as familiar to people as let's say owning an iPhone and then being able to get your head around the Apple business, or owning a computer and saying, oh, I've been using a computer for 20 years, so I understand what Hewlett Packard's product is. Instead, Ternium creates rolled steel, and rolled steel goes into appliances, cars, all kinds of different products. I like Ternium because first, as a company, they're located in Mexico and other Latin American countries. And I think the nearshoring advantage they have to distribute in the US is really attractive to me. I'm going to go through and value Ternium from the ground up based on their free cash flows. And I'll share that with you. I'll go through step by step. And hopefully this gives you a good understanding of how to value a company. It's one thing to find a company you find interesting and you think, hey, that's a good business. They have a very popular product. There's a lot of businesses that seem very popular that aren't worth very much. And there's some businesses that are not very popular or people are aware of, and they're very valuable. So it's really important to separate what is going to be really valuable versus something that's not going to be valuable. It's just popular. And I think discounted free cash flows really separates for me the investments that are really good, the investments that are not good, and I stay away from. So the intent of this video is to help an investor that does not have an accounting background, a finance background, determine the value of a company. As I go into this video, discounted free cash flow method works for, I would say, a majority of companies, but it does not work for companies like banks, companies that have heavy debt burden. It doesn't work for real estate investment trust. They carry a lot of debt. So keep that in mind, that discounted free cash flow method doesn't work for banks, doesn't work for real estate investment trust, REITs. And this is really for companies that make products, they provide services. Most companies, they can get valued through a discounted free cash flow technique or a model. All right, so Ternium is going to be the example company. All the information I'm putting into this model is going to be real information. So we're going to be creating this on this video. It's going to be my creation, my spreadsheet, but I'm going to show you where I get the information. And I believe that it's quite easy to get information. It takes a couple of Google searches, a couple of websites, and we've got the information we need to value a company. Now let's get into it. Now I want to determine the value of Ternium based on their free cash flows. Let me take you through a model that I've created that takes us through and values the company based on free cash flows. First, the first year of free cash flow is $1,040,000,000, which is the amount of free cash flow this company produced for 2023. And each year I'm expecting it to grow, and it's going to grow by about 5% per year. So year one is 2023, 2024, 2025, 2026. Terminal value is the value of all cash flows beyond year four. It's pretty much a mathematical equation that says all the cash flows that we expect in the future amount to this amount, $17.7 billion. And there's a long-term growth within that valuation. And you can see the formula here if you want to take a screenshot of what it looks like. And you can see the fields and the rows and so forth. All these cash flows amount to a value, but the intrinsic value takes all those cash flows and discounts them by 10%. What's a discount rate? Based on the risk of a company, you'll have a higher or lower discount rate. You could also think of it as your return on this investment. And the discount rate is used to discount all those future cash flows to a present value. In this case here, the present value is $14.5 billion. So the present value of all those free cash flows are $14.5 billion. The cash flow on the balance sheet is $1.8 billion. So I'm going to add that on, and I'm going to take away the debt to get to an equity value of $14.2 billion. Now, purely the intrinsic value of the cash flows is 14.5, but let's say this company had a lot of debt. I would be taking value away from the company. This is my model. That's my investing approach. And I think that's fair. And then some companies carry a lot of cash. Well, that's a positive. It makes the company less risky. So that's how I get to my equity value. The market cap of the company is currently at $8.3 billion. There are 196 million shares outstanding for the company. So based on the number of shares outstanding, the amount that I calculated to be the value of this company, I think each share is worth $72.49, but they're being sold on the market for $42.50. So using free cash flows, I believe that this company is discounted by 71%. And that's how I value a company using free cash flows and then compare them to the current stock price on the marketplace. So where do I get the information that I need for this model? Well, it's from the financial statements. And getting to the financial statements on any publicly traded company is easy. In Google, I just put in the symbol of the company, investor relations, and it takes me to the right place where I can land on the company's website that is investor relations section of their website. All right, so getting familiar with a company I'm going to invest in is a very good idea. And here, very quickly, it tells you, okay, what do you want to see? I'd like to see quarterly reports. You could also look at, the SEC filings. That's where they'll put their financials. And I can see for 2023, I can look at their financial statements for Q4. I'm going to look at a full year. That way it's easy. This is kind of a starter, video on how to look at financial statements. Once we're into the financial statements, we could see that they're providing the income statement, the balance sheet, and the statement of cash flows, and that's on page 10. So we will go to page 10 and get to the statement of cash flows. The statement of cash flows just basically says this is what we use cash for. We use it for operations, we used it to invest, and we used it to finance, or we got money from financing. We are most interested in cash from operations. That's going to be the number we start with, and we're going to take away capital expenditures. So we take one from the other, and we get to our net cash flow, which ends up being $1,040,000,000. Now, let me explain why this makes sense as free cash flow. First, cash from operations makes sense because the business operated, and this is the amount of cash we generated at the end of the day. How much money did we have to put back into the business to either buy new machines, replenish the machines, fix the machines, all kinds of things, or whatever infrastructure they need to have? That's the capital expense. So I'm going to take that away from the cash that I just generated from operations. And the net is free cash flow. And that's a very important number for our valuation. That's a very important number in value investing. We determined what the free cash flow was. Now we need to look at where the company balance sheet is so we can look up the cash on the balance sheet as well as debt. And in the same set of financials, we will find the balance sheet. We're going to leave the cash flow statement and we will get to the balance sheet. And in Europe, they call it a consolidated statements of financial position. In the US, we call it a balance sheet. So it's the same document. And The other thing that's interesting about Europe is they put current assets below non-current assets. So we look below and see that there is cash and cash equivalents of $1.8 billion. So that number I'm going to use in my model, which I did, and use that to add value to the company. Now, I also want to look at debt, and I need to look in two places. And the first one is borrowings, which is in the non-current section of 1.2 billion. And I need to add 940 million, which is in the current liabilities, because it looks like they owe some of the debt and it's due in the next 12 months, and they have some debt and it's due beyond 12 months. Those two numbers give me the total debt amount. One more note on the balance sheet or statement of cash financial position, as they would say in Europe. Sometimes you need to add cash in short-term investments. A company may have so much cash that they're like, hey, we'll earn a better interest if we go into some short-term bonds. So let's buy those. Those would be short-term investments. It's pretty much cash. So you add those two amounts to get to your cash position. So that's where we get our amounts for cash and debt. So I calculated the value of the free cash flows for Ternium, but that's just one part of my decision. I have a criteria. It's pretty straightforward, but it's complete in my mind. I first want to completely be bought in on the business. I want to believe in the business. I want to believe that they have competitive advantage, or that, their products are highly desired. All those things are really important. That's the most important part. I have to buy into the company. And in this case here at Ternium, I'm really bought in. I like their near shoring aspect to it. I think it's a big competitive advantage. I think the US is moving a lot of its supply chain from China to a near shore. Mexico is just south of the US with a less expensive labor pool. So that is a huge advantage. I think the company has operated very well. I listened to their earnings. The management team is just excellent. They really operate well. Debt is well below 3 times EBITDA. So that is in good shape. The balance sheet, as you saw, they have almost as much debt as they do cash. Or maybe I said that backwards, but they could basically pay off all their debts if they wanted to. Overall, this is a high dividend paying stock. I didn't cover that a whole lot, but you would see this a high dividend payer. And they offer just a fantastic discount. And this is a cyclical industry. If metal prices go up, you better believe Ternium is just going to go through the roof. And if metal prices go down, the stock price will suffer, but it's a great time to buy a company like this. So overall, I am going to continue to buy shares in Ternium. I think it's a really good investment. I'm really glad that I bought it. My investment in Ternium so far has been positive. I have $41,000 invested in this stock, and the current value of those shares is $47,708. So I have an unrealized gain on this stock of $6,653, which is up 16%. It also pays a dividend rate of 7.7%. I really like that. And they've been very good about paying that dividend. So combined, it really provides a really nice return. And again, I'm really glad that I bought this investment. I think material prices are going to rise in the future because the economy hasn't been doing great. But once it starts picking up momentum, material prices are going to increase. When that happens, the price of Ternium is going to go up as well. Thank you for watching the video. I hope you found it interesting. I'm glad that I took time to go through a valuation using free cash flows on Ternium. And it was directly a result of a viewer of a live stream suggesting it. I hope you found it interesting, and I hope that you leave a message or a comment on this video, just helping me improve the videos. And more importantly, if you have a comment on Ternium, I'd love to hear your opinion on this company. Remember that everything that I do is about sharing my experience and my journey as an individual investor. Nothing I share on my videos is ever financial advice, and I never recommend you buy any stock I cover, including Ternium. I don't recommend that you buy or sell the stock. Thanks again for watching.